They told the public the economy was strong. Headlines celebrated job growth, markets cheered, and financial commentators declared victory for economic resilience. Within hours of the announcement, gold and silver prices collapsed sharply, reinforcing the narrative that investors were moving away from safe haven assets. But beneath the surface, something didn't add up. Quietly, revision data began to circulate among analysts and traders who looked beyond headlines. Over 1 million previously reported jobs suddenly appeared questionable, revealing one of the largest employment overstatements since the 2009 financial crisis. At the same time, a strange divergence appeared in global silver markets. While Western exchanges showed falling prices, Shanghai buyers were paying dramatically higher premiums for physical metal. Delivery notices surged past normal levels, signaling intense demand for real assets instead of paper promises. The contrast between official optimism and market behavior created a silent alarm, one that only a few observers seemed ready to acknowledge. The mainstream narrative painted a picture of prosperity, but experienced market participants noticed subtle inconsistencies. They had seen similar patterns before, strong economic headlines followed by sudden corrections months later. Investors who relied solely on initial data often found themselves reacting too late when revisions changed the story. As financial markets celebrated, professionals dug into the details hidden deep within official reports. They examined footnotes, methodological explanations, and secondary tables that rarely received media attention. There they found signals suggesting that employment strength might not be as solid as claimed. Meanwhile, physical silver demand was increasing rapidly, particularly in Eastern markets where buyers focused on tangible assets rather than financial instruments. This divergence hinted at a deeper disconnect between perception and reality. While traders in paper markets responded to headlines, those dealing in physical commodities acted on supply shortages and long-term expectations, creating a growing gap between the two worlds. On a Friday morning in early 2025, two major events unfolded simultaneously. The Bureau of Labor Statistics released its monthly employment report, announcing job growth that exceeded expectations. Almost instantly, precious metals markets reacted. Silver dropped several dollars per ounce, and gold fell sharply as traders interpreted the data as proof of economic strength. Financial media outlets framed the reaction as logical. Strong employment meant higher confidence, stronger currencies, and less demand for safe assets. But while television analysts praised the report, professional traders began comparing price movements across global markets. They noticed unusual resistance from physical buyers who continued purchasing metal despite falling futures prices. Within hours, whispers circulated among trading desks that something more complex was happening beneath the surface. The sell-off looked aggressive, almost engineered, occurring during low liquidity periods when large orders could move markets quickly and trigger automated selling systems. The employment report itself seemed straightforward at first glance. It claimed that over 100,000 new jobs had been added, beating forecasts and strengthening the narrative of a resilient economy. Stock markets surged as investors shifted capital into growth assets, while the US dollar gained strength against major currencies. Precious metals, traditionally seen as hedges against uncertainty, were rapidly sold off. Yet experienced analysts understood that headline numbers rarely told the full story. They examined underlying data, historical revisions, and seasonal adjustments to identify potential distortions. Some noticed discrepancies between employment growth and other economic indicators such as freight volumes and industrial output. The disconnect raised questions about whether the labor market was truly as strong as reported. Meanwhile, institutional investors began monitoring physical commodity flows, which often provide a more reliable indication of real economic activity than survey-based statistics. Within hours of the initial sell-off, a remarkable divergence appeared between Western and Eastern silver markets. While New York futures traded near $84 per ounce, Shanghai buyers were paying nearly $90 for physical metal. The premium, which had been relatively modest days earlier, suddenly doubled. Such a difference was unusual in modern markets, where arbitrage typically keeps prices aligned globally. Traders expected the gap to close quickly, but instead it widened. Eastern buyers continued accumulating physical silver despite falling paper prices. This behavior suggested that demand was not speculative but driven by real industrial needs or long-term strategic positioning. Analysts began questioning whether Western futures prices truly reflected physical supply conditions. The growing premium indicated a potential breakdown in global price discovery mechanisms, highlighting the difference between paper contracts and tangible assets in an increasingly uncertain economic environment. Veteran traders recognize the divergence as a warning sign rather than an anomaly. Historically, when paper prices declined while physical demand remained strong, markets were often experiencing hidden stress. They remembered previous periods when official narratives conflicted with real-world data, leading to sudden corrections later. The premium in Shanghai represented more than just regional demand, it reflected a shift in trust. Buyers in Eastern markets appeared less concerned with short-term price swings and more focused on securing actual metal. Meanwhile, Western markets remained dominated by leveraged futures trading, where prices could be influenced by large institutional orders. The growing gap between physical and paper prices suggested that market participants were questioning the reliability of financial instruments. As the divergence widened, it became increasingly difficult to dismiss as temporary volatility. At the same time, unusual activity appeared on the COMEX Futures Exchange. Delivery notices for the February silver contract surged far beyond expectations. Instead of rolling contracts forward or settling in cash, traders demanded physical delivery at unprecedented levels. Over 45,000 contracts stood for delivery, representing tens of millions of ounces of silver. This exceeded the open interest that existed when the contract first began trading, an extraordinary development rarely seen in commodities markets. Under normal conditions, only a small percentage of contracts require physical settlement. The sudden surge suggested that market participants were losing confidence in paper claims and seeking tangible assets instead. Exchange inventories faced unexpected pressure, raising concerns about whether sufficient metal was available to meet demand. Financial media largely ignored the delivery surge, focusing instead on stock market rallies fueled by strong employment headlines. Television analysts praised economic growth and encouraged investors to embrace risk assets. Meanwhile, those studying commodity markets saw a very different picture emerging. Physical demand was increasing rapidly, and premiums were rising globally. Dealers reported longer wait times for coins and bars, and refineries struggled to keep up with orders. The disconnect between official optimism and physical market stress grew more apparent each day. Investors who followed only mainstream narratives remained unaware of these developments, while professionals tracking supply chains began preparing for potential disruptions. Buried deep within the employment report was the revision data that changed everything. While headlines celebrated job creation, the report quietly revised previous months downward by massive amounts. When analysts added the revisions together, they discovered that employment had been overstated by hundreds of thousands of jobs over several years. The cumulative effect approached 1 million non-existent positions. This revelation fundamentally altered the narrative of economic strength. It suggested that growth had been weaker than portrayed, raising questions about the reliability of preliminary data. Market participants who studied revisions understood that initial optimism often masked underlying weaknesses that only became visible months later. The dual shock became clear as analysts connected the dots. On one hand, markets celebrated strong employment data. On the other, physical commodity markets signaled stress and uncertainty. Expanding premiums, surging delivery demand, and growing distrust in paper instruments suggested that sophisticated participants were preparing for a different reality than the one presented in headlines. Investors began questioning whether financial markets were reacting to narratives rather than fundamentals. The divergence highlighted the importance of examining multiple data sources rather than relying solely on official statistics or media interpretations. Experienced observers noticed a recurring pattern. Strong economic headlines were often followed by immediate sell-offs in precious metals, only to be contradicted later by revisions and physical market strength. This cycle repeated over several years, creating a widening gap between reported conditions and actual economic activity. Analysts who tracked revisions maintained detailed spreadsheets comparing preliminary and final data. Their findings revealed consistent overstatements that gradually eroded confidence in official statistics. The pattern suggested systemic optimism built into early estimates, which later required significant corrections. Page 37 of the employment report contained the most shocking number, a massive downward revision approaching crisis-era levels. The figure represented one of the largest corrections since the financial turmoil of 2009. It indicated that hundreds of thousands of reported jobs had never existed. The revelation shook analysts who relied on employment data to forecast consumer spending, corporate earnings, and economic growth. Businesses that had expanded operations based on optimistic reports now faced the possibility that demand had been overstated from the start. This wasn't an isolated incident. Similar downward revisions had occurred in previous years, creating a pattern of systematic overestimation. Each time, initial reports suggested strong growth, only for later data to reveal a weaker reality. Economists began questioning the methodology behind employment surveys and the assumptions used to estimate new business formation. The repeated pattern undermined trust and forced analysts to reconsider how they interpreted official statistics. Investors who ignored revisions risked making decisions based on inaccurate information. The scale of the discrepancy became clearer when comparing revised employment growth with earlier projections. What initially appeared to be robust expansion turned into modest gains spread over longer periods. Monthly job creation averages dropped dramatically after revisions, suggesting that the labor market was far weaker than initially believed. The difference between preliminary optimism and final reality created challenges for policymakers, investors, and businesses alike. Decisions based on inflated data often resulted in overinvestment and strategic miscalculations. Understanding the methodology behind employment reporting revealed why revisions occurred. Initial estimates relied heavily on surveys and statistical models designed to provide rapid updates. While useful for timely analysis, these methods were prone to errors and assumptions that didn't always reflect real conditions. Actual payroll data, which provided more accurate insights, arrived months later. The delay meant that initial narratives often shaped market reactions long before accurate numbers were available. One controversial component was the birth-death model, which estimated job creation from new businesses. During periods of expansion, the model assumed ongoing growth, adding jobs that might not yet exist. When economic conditions weakened, the model often overestimated employment levels. Analysts argued that this systematic bias contributed to recurring overstatements. By the time corrections were made, markets had already reacted to the earlier optimistic numbers. Businesses across industries made strategic decisions based on preliminary employment data. Companies expanded operations, investors allocated capital to growth sectors, and small businesses increased inventory expecting strong consumer demand. When revisions revealed weaker conditions, many found themselves overextended. The ripple effects reached supply chains, credit markets, and hiring plans, highlighting the importance of accurate economic indicators. The implications extended beyond employment figures. GDP calculations, consumer spending forecasts, and central bank policies all relied on labor market data. When foundational numbers were revised by massive amounts, confidence in broader economic models weakened. Analysts began exploring alternative indicators that could provide more reliable insights into real-time conditions. Physical commodity markets, energy consumption, and freight activity became increasingly valuable sources of information. As trust in official data declined, investors turned to tangible assets. Gold and silver gained renewed attention as stores of value that couldn't be revised through statistical adjustments. Physical demand surged globally, reflecting a desire for assets perceived as independent from financial systems. Market participants recognized that while numbers on paper could change, physical commodities represented measurable realities. A trader in Singapore observed the growing divergence between Western and Eastern markets firsthand. Watching simultaneous price feeds, he noticed the widening gap between futures contracts and physical spot prices. The persistent premium in Shanghai signaled strong demand that couldn't be explained by temporary arbitrage inefficiencies. The divergence suggested structural differences in how markets valued tangible assets versus financial instruments. As the premium doubled within days, analysts concluded that either supply shortages or intense demand, or both, were driving the disparity. Eastern buyers prioritized physical ownership, viewing futures contracts as insufficient during uncertain times. This behavior reinforced the perception that global price discovery mechanisms were evolving, with physical markets gaining influence over traditional paper-based benchmarks. COMEX delivery data added further evidence of market stress. Demand for physical settlement reached levels rarely seen in modern trading. The exchange's inventory management systems faced unprecedented pressure as more participants requested metal instead of cash. Such behavior indicated declining trust in paper contracts and growing concern about future availability. Coin dealers and refineries reported increasing delays and backlogs as demand surged. European distributors struggled to maintain inventory, while Swiss refineries operated at maximum capacity. Mining companies saw forward purchase agreements at prices above spot markets, suggesting expectations of future scarcity. Each signal pointed toward tightening physical supply conditions. Meanwhile, large sell orders continued appearing in paper markets during low liquidity hours. These trades often triggered algorithmic selling and sharp price declines, yet physical buyers consistently absorbed the dips, purchasing metal whenever prices temporarily fell. The pattern created repeated cycles of paper market volatility followed by physical market recovery. Observers described the dynamic as a battle between paper and physical markets. Financial instruments allowed for the creation of vast quantities of contracts, but physical commodities remained limited by real-world production and storage constraints. As demand increased, the balance between these systems shifted, challenging traditional pricing mechanisms. Business leaders facing uncertain data began developing new decision-making frameworks. Instead of relying solely on official statistics, they tracked independent indicators such as diesel consumption, electricity usage, and freight volumes. These metrics provided real-time insights into economic activity that were less susceptible to revision. Executives also monitored precious metals markets as indirect indicators of global sentiment. Rising premiums and delivery demand signaled declining trust in financial narratives. By cross-referencing multiple data sources, companies attempted to build a more accurate picture of economic conditions before committing to major investments. Historical parallels emerged with previous crises where official data lagged behind reality. In 2008, warning signs appeared in credit markets and commodities long before mainstream narratives shifted. Analysts recognized similar patterns forming again, prompting cautious strategic planning and increased focus on liquidity. As revisions accumulated and physical market stress intensified, the gap between narrative and reality grew harder to ignore. Some investors positioned for continued optimism, while others prepared for potential corrections. The divergence created one of the most complex environments for decision-making in recent financial history. Ultimately, markets tend to reconcile narrative with reality. When revisions reach a scale that cannot be dismissed, perceptions shift rapidly. The massive employment correction, combined with unprecedented physical demand in precious metals, suggested that deeper changes might be underway. Whether the adjustment would occur gradually or suddenly remained uncertain, but history showed that physical realities eventually outweigh statistical narratives. The only question left was timing, and who would recognize the signals before the broader market finally caught on.